Ever wished for a money tree in your backyard sprouting crisp $100 bills? Sounds great, right? Just print more cash. But if it's so simple, why aren't we all rich? Imagine the government fires up the money printer and hands everyone a fat bonus. Suddenly everyone's wallet is bulging. People rush out to spend. Shopkeepers see the surge and raise prices. First a little, then a lot. More money is chasing the same amount of stuff. TVs, cars, bread, even pickles. The supply of goods hasn't increased, just the cash. So while your wallet feels fatter, each dollar actually shrinks in value. This is inflation. It's a phenomenon that affects everyone, from the wealthiest investor to the average consumer. It's a complex economic issue, but at its core, it's about the value of your money. Inflation happens when your money buys less and less. The same amount of cash in your wallet can no longer purchase the same goods and services it once did. You start to notice that everyday items, like groceries, become more expensive. Think of it like a balloon. Imagine the economy as this balloon, and the money supply as the air inside. If you print more money, essentially pumping more air into the balloon, but don't make more stuff, meaning the size of the balloon stays the same, and the amount of goods and services available doesn't increase. Then the value gets stretched thin. Each unit of money represents a smaller fraction of the total value. To understand this better, imagine a tiny island, a closed economy where resources are limited. Let's say there are 10 coconuts and 10 coins circulating within the island's economy. In this scenario, the natural exchange rate is 1 coconut per coin. It's a simple, balanced system. Now imagine the tribal chief decides to stimulate the economy and doubles the coins in circulation. But the number of coconuts, the actual goods available, stays the same. There are still only 10 coconuts. Suddenly, coconuts cost 2 coins. The price has inflated because there's more money chasing the same amount of goods. You're not richer, even though you have more coins. You're just paying more for the same thing. The purchasing power of each coin has decreased. Ultimately, money's value comes from what it can buy, its ability to facilitate transactions and acquire goods and services. It's not about the number printed on it, but the real-world value it represents. Double the money, with the same amount of goods available, and prices will inevitably double too. It's a direct consequence of increasing the money supply without a corresponding increase in production. Inflation hits hardest for ordinary people, those who rely on fixed incomes and struggle to keep up with rising costs. It disproportionately affects pensioners and savers, whose money suddenly buys less, eroding their hard-earned savings and reducing their standard of living. It's a silent thief, subtly diminishing the value of your wealth over time. And it's often born from the seemingly simple, but ultimately flawed, just print more idea. Does this really happen? Absolutely. Let's visit Zimbabwe in the late 2000s. The government printed money, lots of it. The result? Hyperinflation. Prices doubled in days, even hours. People needed wheelbarrows of cash for a loaf of bread. The government kept adding zeros, millions, billions, even $100 trillion note, worth almost nothing. Eventually, the Zimbabwean dollar was abandoned for foreign currencies. Shops were empty, the currency too unstable to use. It's a stark reminder, just because a government print money doesn't mean it. Hyperinflation destroys trust, savings, and economies. The lesson? Printing money isn't a free lunch, it can turn into an economic nightmare. So, the big question remains, is all money printing inherently bad? Is it a universally negative action with no potential benefits? Not always. It's a nuanced issue with varying degrees of impact. Enter quantitative easing, often referred to as QE. This is where things get interesting. QE is a monetary policy tool, where central banks create new money, essentially conjuring it into existence digitally. But crucially, they use it to buy assets, primarily government bonds and other securities, from commercial banks and other institutions. The newly created money doesn't directly hand it out to consumers or businesses, it stays within the financial system. The primary goal is to inject liquidity into the financial system, making it easier for banks to lend money. This increased liquidity is intended to lower interest rates across the board, making borrowing cheaper for businesses and individuals. Ultimately, the aim is to stimulate economic activity and stabilize the economy, particularly during times of crisis or recession. If managed carefully, with a clear understanding of the economic conditions, and if the economy demonstrates genuine signs of growth and increased productivity, then a bit of new money entering the system might not necessarily cause runaway inflation or destabilize the economy. It's a delicate balancing act, a tightrope walk between stimulating growth and controlling inflation. Too much money creation, and you risk triggering inflation, eroding purchasing power, and destabilizing the currency. Too little intervention, and the economy stalls, potentially leading to recession and widespread hardship. Economists continue to debate whether QE truly works as intended in the long run, and what its unintended consequences might be. Some argue that it merely delays inevitable problems, essentially kicking the can down the road. Some say it's a vital tool, absolutely necessary to prevent a complete economic collapse and systemic failure, while others worry that it quietly devalues the currency, eroding the savings of ordinary citizens. The truth, as is often the case with complex economic issues, it's incredibly complicated and multifaceted. The simple adage, print money, get poor, isn't always the full story, and often oversimplifies a much more intricate situation. Sometimes, in specific circumstances, it's not just about printing money, but about how, and more importantly, why the money is created, and what it's ultimately used for. So, printing money doesn't automatically make a country richer. It's not a simple equation where more printed money equals more wealth for everyone. Usually, in fact, it does the opposite. Flooding the market with more currency can lead to inflation, where the value of each dollar decreases, and prices for everyday goods and services rise. But as we've seen, sometimes it's more nuanced than that. The relationship between money supply and economic health isn't always straightforward. Take, for example, quantitative easing, or QE, a tool used by central banks to stimulate the economy. The world of money and economics is a complex maze, a labyrinth of interconnected systems and ideas. It's full of strange concepts like fractional reserve banking, where banks only hold a fraction of deposits in reserve, lending out the rest. And then there are cryptocurrencies, digital or virtual currencies that use cryptography for security. Don't forget fiscal policy, the use of government spending and taxation to influence the economy. Understanding the basics of these concepts isn't just for economists or financial experts. It's something everyone can benefit from, because it directly affects your daily life, the choices you make and the opportunities available to you. It impacts prices, jobs, and even your savings. Knowing how money works empowers you to make smarter financial decisions for yourself and your family. It also helps you see through the spin and understand the real implications of economic news and policies. The story of money is always evolving, from bartering to coins to paper money and now to digital forms. This is especially true now with the rise of digital currencies and blockchain technology. We are witnessing a revolution in financial tech, transforming how we interact with money. Who knows what's next in this rapidly changing landscape? The possibilities are endless. Maybe one day we'll routinely buy pickles with Bitcoin or some other form of cryptocurrency. But one thing's certain, money in whatever form it takes will continue to shape our world and influence our lives in profound ways. So stay curious, keep asking questions, and exploring new ideas. Because in the world of money and economics, there's always more to learn and discover.